It is a fine time to be mining iron ore. Rio Tinto, the world's second largest exporter of the stuff, a key ingredient in steel, said profit in the first half of the year tripled to almost $6 billion. With us this morning to discuss the outlook for the second half and beyond is CEO Tom Albanese. Tom, welcome. We can boil down Rio's extraordinary performance really to two things, both of which were largely your doing: a multi-year effort to cut costs and a shift in iron ore pricing to quarterly contracts. Let me start with this. Is Rio Tinto lean enough now? And if not, how much more can you take out in costs?
Yeah, I think it's quite important to recognize $5.8 billion record earnings this year. This was, as you say, partly strong markets, but also our operations, our first-class operations. They delivered the tons when the tons were needed in the marketplace. This is very strong performance, and these were quality earnings backed up by the fact that in the first 6 months this year, these operations generated $10 billion of cash flow. Very strong numbers. That allows us to take, and again, we were very strongly leveraged by the very difficult and aggressive cost cutting of last year. We preserved those gains from the cost savings this year, but we also kept sufficient muscle in the businesses so that we can deliver tons to the market. Now, as we look ahead, we continue to see strength in these markets. So I am announcing today that over the next 18 months, we will be spending about $13 billion to continue to build these businesses. We got to keep them lean on cost, but I want to get more tons because the market can use those tons.
The market can use those tons for sure, but one of the big questions hanging out there, Tom, is about the iron ore pricing system. Is it going to survive in its current form? As you know better than me, it's come under a whole lot of criticism from steelmakers, all of whom can see the extraordinary impact that it's having on your bottom line.
I think that what we've seen over the past couple of years is an evolution. The annual benchmark price, which is a 30-year construct, has been matched with a more volatile and a more liquid spot market. And what we were seeing last year is that people that would otherwise be buying into the benchmark would be buying into the lower spot market during the midst of the financial crisis. So we moved into a quarterly system this year. And I think so far it's working. While quarterly prices have been going up over the course of this year, spot price, they've been driven off of the overall average spot price. And that's what we would expect to see as the spot market becomes more important. The quarterly prices will follow that, and that's what's happening.
So you expect quarterly prices to come down?
Well, again, I would have to say that quarterly prices will follow the spot market. Now, over the past 2 or 3 months, we did see spot prices dropping a bit, but over the past few weeks, they've come up again by about $20, $25 a ton.
Tom, much of the world's expectations for commodities are pinned on the Chinese economy. What are your people telling you about the health of the Chinese economy and the outlook?
Look, I see two big things that we've got to watch in the world today. One is the structural defects in the West, particularly around sovereign risk. But second would be associated with how does the Chinese maintain the growth of the economy without overstimulating, also without making it, tightening it too hard, that Goldilocks point. And again, what we've been seeing is that 10 to 11% GDP growth is probably not sustainable. That probably will drive a bubble down the road. And from my own perspective, I think what China's been doing in terms of tightening the economy, while it's creating some short-term pain, will bring it back into that 8 to 9% growth rate, which for us is more sustainable. And that $13 billion we're spending in capital over the next 18 months is not for today's markets, but it's for those markets 2, 3, 4, 10 years down the road. So sustainable GDP growth is for us more important than real spectacular short-term growth.